Welcome back to Smart Money Moves, where we break down the complexities of the financial world so you can make smarter investment decisions. Whether you're a seasoned investor or just starting your journey, we've got you covered. So if you like our videos, hit that subscribe button and never miss out on valuable insights. If you missed it, check out our last video where we broke down why Warren Buffett still isn't in the electric vehicle space. And if you haven't already, watch our latest video on the #1 reason oil prices are going up. You don't want to miss these insightful analyses. Now let's turn our attention to today's burning question. Should you be concerned about rising interest rates? As the Federal Reserve continues to monitor inflation, many investors are left wondering how rising interest rates might affect their portfolios. Well, let's discuss this further. Before we dive into the impact of rising interest rates, let's take a moment to acknowledge the significant event that has captured the nation's attention, the ongoing Women's World Cup. Tonight's match between the US and Sweden promises to be an exciting one. Both teams have demonstrated exceptional skills and determination throughout the tournament. The US team, known for its powerful offense and strong defense, will face a tough challenge against Sweden, a team renowned for its tactical discipline and resilience. The stakes are high as both teams vie for a spot in the next round. It's a battle of styles, a clash of titans. Who will emerge victorious? Only time will tell. But one thing is certain, the future of the Women's World Cup hangs in the balance. But now let's shift our focus back to the topic at hand, rising interest rates. As the Federal Reserve works to combat inflation, many investors are left wondering how these rising interest rates might affect their portfolios. One of the most significant impacts of rising interest rates is the effect on fixed income investments, such as bonds. When interest rates rise, the value of existing bonds tends to fall. This is because new bonds offer higher yields, making older bonds with lower yields less attractive to investors. For example, if a bond is paying a 2% yield while new bonds are being issued at 4%, investors will likely flock to the newer, higher-yielding bonds, driving up their prices and lowering the prices of existing 2% yielding bonds. Another key aspect to consider is the increased cost of borrowing. Rising interest rates directly result in higher borrowing costs for individuals and businesses alike. When loans and credit cards become more expensive, consumers may cut back on spending, which can impact corporate profits and overall economic growth. Additionally, higher borrowing costs can affect the real estate market, potentially leading to a slowdown in sales and lower property values. Moreover, rising interest rates can disproportionately impact certain sectors more than others. For instance, the housing sector is particularly sensitive to interest rate changes. When mortgage rates increase, housing affordability declines, which can lead to a decrease in demand and subsequently affect the prices of home builders and real estate investment trusts. However, not all investments are negatively affected by rising interest rates. Certain sectors, such as banking and insurance, tend to benefit from a rising rate environment. Banks, for example, can lend money at higher rates, increasing their profit margins. Additionally, insurance companies invest the premiums they collect in fixed income securities, and those investments can generate higher returns in a rising rate environment. That said, rising interest rates can also have broader implications for the economy. One concern is that higher interest rates could potentially push the economy into a recession. When businesses face higher borrowing costs, they may scale back on expansion plans or even cut jobs, leading to a decline in economic activity. Furthermore, consumer spending, a major driver of economic growth, can take a hit when households face higher interest rate payments on mortgages, credit cards, and other forms of debt. So what should you do? As a cautious investor, you should consider diversifying your portfolio to include assets that have historically held their value or even appreciated during inflationary periods. One such asset class is fine art. Historically, the art market has shown resilience during inflationary times, as art prices tend to appreciate at a similar rate to inflation. In fact, from 1995 to 2021, the total return for contemporary art was around 237%, outpacing the S&P 500's total return of 184%. Additionally, the art market has demonstrated low correlation to traditional asset classes such as stocks and bonds, making it a valuable addition to any well-diversified portfolio. Moreover, the art market has shown a remarkable ability to bounce back quickly from economic downturns. During the global financial crisis of 2008, while the stock market plummeted, the art market only saw a minor dip, demonstrating its inherent stability. Investing in fine art, however, has traditionally been limited to the ultra-rich due to high upfront costs and a lack of liquidity. But with Masterworks, investing in fine art is now possible for everyone. Masterworks is democratizing access to this exclusive asset class by allowing anyone to invest in fine art. Once they purchase the artwork, Masterworks then sells shares of that artwork to investors like you and me, enabling us to own a piece of the artwork without having to physically store it. If the artwork appreciates in value, investors can realize substantial capital gains. So if you're looking to diversify your portfolio and take advantage of the potential benefits of fine art, I encourage you to visit the link in the description below to learn more about Masterworks and start investing in fine art today. Thank you, Masterworks, for sponsoring this portion of the video. As always, thank you for watching. Until next time, remember to stay curious, keep learning, and make smart money moves.